What if I told you that the mortgage you're eyeing right now could cost you tens of thousands of dollars more than you ever expected? Not because of hidden fees buried in the fine print, not because of bad luck, but because you chose the wrong type of mortgage, one that made perfect sense years ago, but has become a financial trap in the world we're living in today. Right now, in 2026, the American real estate market is facing a very specific set of conditions. Interest rates have been through a brutal roller coaster over the past few years. Home prices in many regions are still elevated. Inflation has forced families to rethink every single financial decision they make. And in the middle of all this, millions of buyers are walking into banks and mortgage offices still asking for products that simply don't protect them the way they need to be protected right now. Here's the uncomfortable truth. Not all mortgages are created equal. And more importantly, what worked in a low-rate, stable market is not necessarily what works in today's environment. Some mortgage types that were popular or even smart choices in previous years have become liabilities. They carry risks that many buyers don't fully understand until it's too late, until they're locked in, until the monthly payment jumps, until refinancing costs more than they saved. So before you sign anything, before you shake anyone's hand, before you wire a single dollar, watch this video to the end, because I'm going to walk you through the 5 types of mortgages that financial experts, real estate analysts, and experienced home buyers are avoiding in 2026. And I'll explain exactly why each one has stopped being a good deal and what smarter alternatives look like. This isn't about fear. This is about information. Let's get into it. Let's start with one of the most misunderstood mortgage products on the market, the adjustable rate mortgage, commonly known as the ARM. For a long time, ARMs were genuinely appealing. In a falling rate environment, they could save you money. But in 2026, after years of aggressive rate hikes and persistent inflation, ARMs have become one of the riskiest choices a home buyer can make. The way an ARM works is straightforward. You get a fixed interest rate for an initial period, usually 3, 5, or 7 years. And after that, the rate adjusts periodically based on market conditions. The problem is that when rates are already high and unpredictable, that adjustment can be brutal. Homeowners who locked in an ARM a few years ago have watched their monthly payments climb by hundreds of dollars. Some have been forced to sell. Others have defaulted. The initial teaser rate that looked so attractive on paper became a time bomb. Unless you are absolutely certain you will sell or refinance before the adjustment period kicks in, an ARM in this environment is a bet you probably shouldn't make. The second type to avoid is the interest-only mortgage. This product allows you to pay only the interest on your loan for a set period, sometimes as long as 10 years, before you start paying down the principal. Developers and real estate investors use this strategy aggressively during real estate booms because it freed up cash flow in the short term. But for the average home buyer in 2026, it creates a serious problem. You are not building any equity. You're essentially renting money from the bank. When the interest-only period ends, your payment jumps significantly because now you have to pay down the principal you've been ignoring, compressed into a shorter repayment window. In a market where home values are uncertain, that combination of no equity and a payment shock is genuinely dangerous. Third on this list is the balloon mortgage. A balloon mortgage gives you smaller monthly payments for a fixed period, typically 5 to 7 years, and then requires you to pay off the entire remaining balance in one large lump sum at the end. In theory, it sounds manageable if you plan to sell or refinance before the balloon payment comes due. In practice, That plan depends on market conditions cooperating. If property values have dropped, if credit conditions have tightened, or if interest rates are too high to make refinancing worthwhile, you could find yourself owing a massive sum with nowhere to turn. For most buyers today, that level of uncertainty is simply not worth it. The fourth type that experts are flagging in 2026 is the piggyback mortgage, also sometimes called an 80-10-10 loan. This is where a buyer takes out two separate loans to avoid paying private mortgage insurance, or PMI. The first loan covers 80% of the home's price. The second covers 10%, and the buyer brings 10% as a down payment. On paper, this structure can seem clever because it avoids PMI costs. But in reality, the second loan almost always comes with a higher interest rate. You're managing two payments, two sets of terms, and two lenders. If your financial situation changes, and in today's economic environment, that can happen quickly, juggling two loans is far more complicated and costly than simply paying PMI on a straightforward conventional mortgage. The fifth and final type to reconsider is the stated income mortgage, sometimes called a no-doc or low-doc loan. These products were common before the 2008 financial crisis and have made a quiet comeback in some corners of the lending market. They allow borrowers to qualify for a loan without fully verifying their income through traditional documentation. While they can seem attractive to self-employed individuals or those with non-traditional income streams, the trade-off is severe. Higher interest rates, stricter terms, and far less regulatory protection. In a market that is already challenging, taking on a mortgage with limited documentation and a premium interest rate is a combination that can unravel very quickly if your income fluctuates even slightly. Now, the goal here is not to scare you away from home ownership. Buying a home in 2026 is still a real possibility for millions of Americans, but it requires making informed choices. The good news is that there are solid, conventional options available. Fixed-rate, 30-year and 15-year mortgages remain the most reliable and predictable products on the market. FHA loans continue to offer accessible entry points for first-time buyers. VA loans remain one of the best deals available for eligible veterans. The tools exist. The question is whether you're using the right ones. Understanding what to avoid is just as valuable as knowing what to pursue. A mortgage is likely the largest financial commitment you'll ever make. It deserves the same level of research and critical thinking you'd give to any major life decision. Don't let the excitement of buying a home rush you into a product that doesn't fit your situation, your risk tolerance, or the realities of this market. If this video helped you see the mortgage landscape a little more clearly, hit that like button and subscribe, because we cover this kind of practical, no-nonsense financial content every single week. And if you're currently in the middle of a home search, drop your questions in the comments. We read them and we respond. See you in the next one.